So in the last part of this chapter, we're going to be covering the petty cash fund. And petty means like small amount, and the petty cash fund is basically a fund that's held in any business just to make any kind of small payments like postage or office supplies or any kind of small payment that we don't really need to record it in a separate transaction. So it's not practical for a business to write checks to pay small amounts for such items as postage, office supplies, or even minor repairs. Therefore, it's desirable to control such payments by using a special cash fund called petty cash fund. And most businesses, they have a petty cash fund in the range of maybe $200 up to like $500. So a petty cash fund is established by estimating the amount of payments needed from the fund during a period, such a week or a month, and a check is then written and cashed for this amount. The money obtained from cashing the check is then given to an employee, and that person would be the custodian or petty cash custodian who is going to make any kind of payments for these kind of small payments. The petty cash fund is normally replenished at periodic intervals, and replenished we mean like we bring it back to its balance when it goes down, so when it's depleted, or when it reaches a minimum amount. So we say if let's say it's a $500 and we say we have to replenish it once it goes down to $100. So we bring it back to $500. So when a petty cash fund is replenished, the accounts debited are determined by summarizing the petty cash receipts. A check is then written for this amount when it's going to be payable to petty cash. So let's see this example. Assume a petty cash fund of $500 is established on August 1st. The entry to record the transaction will be as follows. So we go on August 1st, as you can see here the date, and we debit petty cash and we credit cash. So basically we're moving the cash from the normal cash balance to this account called petty cash. So petty cash is still an asset. It's just something that we are going to debit when it goes up, and when it goes down we're going to credit. And since we're making a cash payment, we're going to credit the cash for $500. The only time petty cash is debited is when the fund is initially established or when the fund is being increased. When we replenish the petty cash, we don't use the petty cash account anymore. We use the cash account. But the first time we're establishing it, we debit the petty cash. So the only time petty cash is credited is when the fund is being decreased. So petty cash is going to be on the debit side if we are like creating it, or if we are increasing its value. Let's say it was $500 and we realized no, that $500 is not enough, let's make it $800, so we're increasing it by $300. So that's the time we're going to debit the petty cash. And the only time we are going to credit the petty cash is whenever there is like a decision to reduce its value. So we made it 500, we realized it's too much, let's reduce it to 300, so we're going to reduce the petty cash by $200, so we credit the petty cash account. So at the end of August, the petty cash receipts indicate expenditures for the following items. We have like office supplies for $380, we have postage, $22, store supplies, $35, we have miscellaneous administrative expenses of $30, for a total of $467. The entry to replenish the petty cash fund would be as follows. We're going to debit all these expenses that we had, like office supplies, store supplies, miscellaneous administrative expenses. Remember, these are either assets or expenses, so when we record them, they're going to be on the debit side, and then we credit cash. One of the common mistakes that people do is that they credit the petty cash account. Don't do that. Just credit the cash account. The petty cash account is not going to be touched unless we are creating it, increasing its amount, or decreasing its amount. So replenishing the petty cash fund restores the fund to its original amount of $500. Now let's talk about something slightly different, which is special purpose funds. So companies often use other cash funds for special needs such as payroll or travel expenses. Such funds are called special purpose funds. So it's a separate fund that we use for a specific purpose. Now let's talk about financial statements reporting and how we present the cash on the financial statements. A company may temporarily have excess cash. In such cases, the company normally invests in highly liquid investments in order to earn interest. These investments are called cash equivalents. So examples of cash equivalent include things like US Treasury bills, notes issued by major corporations, we call them commercial papers, or money market funds. And again, companies would do that whenever they have extra cash, they don't have like a direct use for it right now, so instead of just having it sitting in the bank with no benefit, they just try to have this kind of, I can call it short-term investment. So it's an investment in these kind of treasury bills or money market funds. So companies that have invested excess cash in cash equivalents usually report cash and cash equivalent as one amount on the balance sheet. And why they consider the cash equivalent to cash is because it can be easily converted back to cash, unlike other investments. So if we're investing in real estate, for example, it might take some time to liquidate that real estate. So we see here like cash and cash equivalent, they're in the same line under current assets. Banks may require that companies maintain minimum cash balance in their bank accounts. In this case, we call that compensating balance. So banks sometimes they say you need to have a minimum balance of, let's say, $10,000. Anything below $10,000 is either not acceptable or we're going to start charging you some fees for that. So we have to maintain a $10,000 as minimum in our account. So in this case, we call that compensating balance. And it's normally disclosed in the notes to the financial statements. Compensating balance is often required by the bank as part of a loan agreement or line of credit. And what is a line of credit? It's a pre-approved amount the bank is willing to lend to a customer upon request. So I can go to the bank and ask them for a line of credit, let's say for $20,000. That doesn't mean I'm going to borrow the $10 or $20,000. It's cash available for me once I need it. So it's a line of credit. So I don't need to go through the approval process, but I'm approved up to $20,000. The last thing in this chapter is to do some kind of analysis, some ratios, and the ratio that we're going to be talking about today is something called days cash on hand. So days cash on hand measures how long a company could survive if its sources of revenue were to decline significantly. So if we don't have any kind of revenue, how long can we survive? So it's calculated as cash and short-term investment divided by daily cash operating expenses. So the cash and short-term investments are taken from the year-end balance sheet and represents the most liquid asset. The daily cash operating expenses are computed from the income statement, where we get operating expenses minus the depreciation, because depreciation is not really real cash expense. And then we divide it by the number of the days in the year, which is 365, and we get the daily cash operating expense. So let's see this example. So we have information here that's provided by or from the 3 recent annual financial statements from eBay. And you can see here that we have the cash, we have the short-term investments, we have operating expenses, we have the depreciation expenses. And this is the information that we need in order to calculate this ratio. So for the cash and short-term investments, we add them together year by year, and you can see here from year 1, year 2, year 3, we have some fluctuations. So year 1 was 9.4, and then year 2 it's about 9, and then in year 3 it went up a little bit. The daily cash operating expenses, again we got our operating expenses here, and we subtracted the depreciation expense and we divided by 365. So again you can see that our daily operating expenses keeps going up. Our days cash on hand is simply this cash and short-term investment that we had, and we divided by the daily cash operating expense. And you can see it was 595, 527, and 515. So this means that we can survive based on our cash and short-term investment for how long? For in year 3 here it's 515 days. It was much better in year 1. It was 595. So even though the cash and short-term investment was lower than what we had in year 3, but our daily cash operating expenses were smaller. So that's why you can see that the days cash on hand was actually higher in year 1 compared to year 3. But anyway, this is not significantly bad. I think even there was a decline, it's still good that a company can survive for almost 2 years with no revenue. So I think this is good news. So by that I conclude chapter 7. I wish you all best of luck studying that, and please do the homework, and I'll see you in the next chapter.